Well, our next guest says markets have got ahead of themselves when it comes to the speed and scale of RBA rate hikes ahead, arguing we're not in the same position as other nations where inflationary pressures are significantly higher. To find out, we welcome Cameron Harris and David Clark to the program. David, good to go and see you there. Different here in Australia. What is the main reason why we're not likely to go and see the same inflationary pressures coming through, say, compared to the United States?
Yeah, well, thank you for having me. So, principally, the US is already experiencing very strong wage growth and very high inflation. We haven't had that here yet, and we have some concerns over whether that will happen at all. And primarily, what we have here is a consensus between federal governments, state governments, all of which are running much higher debt levels post the pandemic, is to run a higher immigration program. So we expect to see migration, that is net migration on an annual basis, return back to levels that we saw post-GFC and pre-pandemic. So that's around the 200,000, 220,000 people a year. And we have a look at this chart here. So for a long period of time, migration in Australia averaged 90 to 100,000 people a year, right up until the GFC. And we were able to have wage growth in that 3.5% to 4% range. Post GFC and the Rudd government coming in, that level has increased, and what we see is a trend decline in year-on-year wage growth from that 4% level down to those 2.4% level that we see at the moment. And if you don't have wage growth that is sustainably higher, 3 to 3.75, then you can't have inflation that is in that 2 to 3% level. So if you put those factors together, what we see is an inflationary environment that's a lot flatter here in Australia. It's going to take a lot longer for rate normalisation to occur. So we will see the RBA act to some degree, but compared to what markets are forecasting, which is high twos by the end of next year, instead it will be a slow, steady and much longer grind for the RBA.
David, what about the counter arguments, say, because compared to prior periods at the moment, Australia is not in its own. The world is trying to go and seek a lot of labour at the moment. Just look at job ads and vacancies around various developed markets. Is there a risk that we might not be able to go and attract the same level of migration that we saw previously?
Yeah, it's a risk of probably around students. They're most uncertain. But generally speaking, if you go back over a longer period of time, people like to migrate to countries and locations that are safer, have a strong rule of law, and have good prospects. Australia has all those three, and that's why we've had strong immigration, post World War II and onwards. So whilst it might be a bit bumpy for the next 6 to 12, 18 months, over time we expect immigration to return to those levels, because there's just too many incentives for governments that need to manage higher spending. There's no appetite in the populace for a reduction in social spending, so they'll make Australia attractive one way or another.
So we've got weaker inflationary pressures than what many expect. We also have wage prices that are not likely to go and get up to the same levels. Where does that leave the RBA cash rate? Because, of course, we're looking at, I know some people are talking about a cash rate north of 3%. Is that fanciful in the current environment?
Yeah, I think it is. If you think about Australia and you think about everyone, if we saw interest rates go to that 3% level, it would have a significant impact on house prices in Australia. You would see a very large pullback in valuation. So, I don't see the RBA being on board with that. So more likely we're going to see rates in the mid ones by the end of next year. That's what we're expecting to see. I think the other point, and I think you showed a good chart just before your chart of the day with the mortgage rates in the US. It's worth noting in the US, most mortgages are priced on the long-term bond yields, and so the Fed can increase rates without hurting the household straight away. Whereas in Australia, almost everyone is priced off the short end of the curve. So as the RBA increases rates, we have world record levels of household debt here. So any small increases are more impactful in Australia than they are in the US.
Just a quick one to go and finish off. You're talking about what's going on in the United States. The Federal Reserve, do you have an opinion about whether they'll be able to go and get their neutral rates or go into restrictive territory, given what the economy is looking at the moment with that potential slowdown in inflationary pressures?
Yeah, I think from the Reserve Bank comments that we're seeing coming out most recently, they're going to push quite quickly to get interest rates up to around the mid-2s fairly quickly, and so that they can slow down. They're under a lot of pressure with their inflation rates at the moment. So I think that what they'll do is increase very quickly, and then once they get to a level that they think they're slowing the economy a little bit, then they'll start to tinker a little bit.